All right, let's dive right into this explainer. Today, we're decoding what might just be the ultimate strategy for conservative retirees looking for some absolute peace of mind in the stock market. If you're relatively new to investing, or honestly, if you're just totally exhausted by the emotional roller coaster of those wild market swings, you are exactly in the right place. We're going to unpack a very specific, elite group of companies that have taken the incredibly boring business of everyday life and turned it into a legendary financial strategy. Let's get into it.
So here is the massive dilemma facing pretty much every retiree out there. How on earth do you generate reliable income without losing sleep every time the market takes a dive? It really comes down to a fundamental choice. Do you chase that immediate, high-yield income right now, or do you focus on sustainable growth over time? Because look, when those regular paychecks from your career finally stop, the anxiety around funding your lifestyle can be, well, overwhelming. You absolutely need a portfolio that works just as hard as you did, but without the heart-stopping drops.
To help solve that, here's our roadmap. We'll quickly cover the retirement income dilemma, meet the dividend aristocrats, explore the power of boring businesses, compare stable income versus high growth, see how these companies survive major crises, and finally, build out your retirement blueprint.
Okay, moving right along to Section 1, the retirement income dilemma. Let's look at this battle between income and growth.
Now, the crucial thing to understand here is that chasing the immediate gratification of a massive dividend yield can actually be a really dangerous trap. I mean, it's so tempting to just sort a list of stocks and look for the absolute highest percentage payout you can find today, right? But the research clearly points out that companies offering those sky-high yields often do so at levels that make it almost impossible to reinvest in their own business. They're essentially sacrificing their long-term growth. And even worse, during a rough economy, those high yielders are usually the very first ones to slash their payouts. We literally just saw this when a former giant like Walgreens had to cut its dividend nearly in half. Contrast that with sustainable income, which relies on a healthy balance of growth and truly resilient cash flows.
Let's jump right into Section 2. Meet the Dividend Aristocrats. This is where we meet the elite antidote to those yield traps.
Enter the Dividend Aristocrats. Now, this isn't just some catchy marketing name, it's an incredibly strict mathematical definition. To be a dividend aristocrat, a company has to be in the S&P 500, and it has to have not just paid, but actively increased its dividend payout every single year for a minimum of 25 consecutive years. Think about that for a second. This exclusive club requires a quarter-century of unbroken payout raises. That proves an insane level of financial strength, ultra-conservative balance sheets, and highly predictable cash flows.
And because the rules are so strict, out of the thousands of stocks you could buy in the U.S. markets right now, and even out of the 500 massive companies in the S&P 500 itself, only 69 companies make the cut. Just 69. Out of everything out there, only these select few have had the sheer discipline and the business resilience to give their shareholders a raise every single year for the last 2.5 decades.
That takes us perfectly to Section 3, the power of boring businesses. Let's see what these companies actually do.
You might be wondering, what kind of cutting-edge futuristic companies can pull this kind of streak off? Well, the truth is actually the exact opposite. And this perfectly illustrates how these elite stocks look absolutely nothing like the modern tech-dominated market. If you look at the broader S&P 500 today, nearly 50% of it is made up of massive tech and AI companies. But take a look at the aristocrats. They completely dominate in consumer staples, industrials, and utilities. In fact, out of those 69 aristocrats, a grand total of 2, just IBM and Roper, are actually classified as information technology.
What's really fascinating here is the sheer beautiful boredom of these business models. Take Eversource Energy, for example, generating incredibly steady cash from regulated electricity, or Colgate-Palmolive. They've been raising their dividend for an astounding 62 years, literally just by selling toothpaste and soap. Then you have Realty Income, a real estate trust that famously started with a single Taco Bell back in 1969 and just slowly built an empire. These businesses thrive because, quite frankly, people are always going to need to brush their teeth and keep the lights on no matter what the broader economy is doing.
Moving on to Section 4, stable income versus high growth. This is the classic race of the tortoise and the hare.
This brings us to the core trade-off that you, as an investor, really have to accept. If you're out there chasing high-growth technology stocks, you're the hare. You might see some massive capital appreciation, but man, you are also going to experience some rapid, heart-stopping volatility along the way. And honestly, that's just not what a conservative retiree usually wants. But then over on the right, we have our tortoise, the Dividend Aristocrats. While everyone else is stressing over the latest tech swing, aristocrat investors are just sitting back, enjoying a steady, totally boring, roughly 6% annual dividend growth with significantly lower volatility. What they lack in daily excitement, they absolutely make up for with relentless consistency.
And hey, definitely do not mistake boring for unprofitable. It's a proven fact that dividends have accounted for roughly 1/3 of the market's total return since 1960. 1/3. When you take those consistently growing dividends and reinvest them over time, you are tapping into a true mathematical powerhouse. Combining capital appreciation with steady dividend growth has delivered absolutely incredible total returns over the long haul.
All right, Section 5. Surviving major economic crises. Let's put this strategy to the ultimate historical test.
Because, let's be real, it is really easy for a company to pay a dividend when times are good. But what happens when the whole world panics? Remember, to even be on this list, you need 25 consecutive years of dividend increases. That means to be an aristocrat today, a company had to be raising its payout since at least the year 2000. That means they kept raising it through the bursting of the dot-com bubble, through the absolutely terrifying depths of the 2008 Great Financial Crisis, and, of course, through the unprecedented global shutdowns of the 2020 pandemic. These companies didn't just survive those crashes. They didn't even just freeze their dividends. They actually increased their cash payouts to shareholders through every single one of those catastrophic events. No way, right? But it's true.
This is the true meaning of the all-weather analogy. I mean, we've seen ultra-low interest rates over the past decade, and more recently, we've been hit with highly volatile, rising rates and high inflation. But because these aristocrats sell products that are absolute, non-negotiable necessities, they have a rock-solid competitive advantage. They just keep generating cash flow, and they keep raising that dividend, regardless of shifting inflation or wild interest rate cycles. Your portfolio is basically completely shielded under that umbrella.
Finally, Section 6, Building Your Retirement Blueprint. Let's make this actionable for you. Okay, here is your blueprint for peace of mind. Step 1, completely avoid the trap of focusing only on initial high yields. Do not get lured in by a massive, flashy percentage that's just begging to be slashed later. Step 2, anchor your portfolio with those beautifully boring essential businesses. Find the companies that sell the soap, the electricity, the everyday groceries. And step 3, rely on that consistent 6% average dividend growth. By following these 3 steps, a conservative retiree can secure a predictable, growing stream of passive income that actually outpaces inflation right when the paychecks from work finally stop coming in.
The underlying data reveals a really powerful truth here. Leaning into the boring nature of these businesses is actually their greatest financial superpower. You really don't need to find the next revolutionary AI startup to fund a comfortable retirement. You just need to find the companies that have proven over a quarter of a century or more that they respect their shareholders enough to consistently share their predictably growing profits.
So, I want to leave you with this final thought. Take a hard look at your investments today. Seriously, look at the funds you hold and the individual stocks sitting right there in your brokerage account. Ask yourself, are you holding the tortoise or the hare? Is your portfolio built for short-term excitement, or is it truly built for long-term survival? Thanks for joining me for this explainer, and hey, here's to finding a little more peace of mind in your investing journey.